September 28, 2024. The New York Times publishes a blockbuster report leaking OpenAI's expenditure, and the market is suddenly staring at a terrifying mathematical reality. McDonald's, Starbucks, Target, Ford, and Coca-Cola. If you combine their capital expenditures for the year 2025, you'll reach the amount that OpenAI alone spent in the year. That is ridiculous. It becomes even more staggering when you realize that to even consider reaching profitability, OpenAI is projected to burn through another $143 billion. That is not a traditional business plan. That is the GDP of a small nation set on fire to train a statistical model. But that is just one company, and that is just 1 year's spend. The bubble we are currently inflating is much, much bigger than OpenAI. We are witnessing a financial anomaly so massive it is actively distorting the global economy, driven by the absolute terror of missing out on the next industrial revolution. To understand how we got here and how this inevitably ends, we have to break down the mechanics of this phenomenon. Over the course of this breakdown, we will look at the trillion-dollar bet these companies are aiming for, the demand gap between reality and expectation, the pipe dream they're all building towards, the echo chamber keeping the money flowing, and finally, the math behind popping the bubble that everyone is talking about. Right now, the technology sector is locked in a brutal, physical infrastructure arms race. They are fighting a war over data centers, power grids, and silicon, driven by the deeply held belief that AI is a winner-takes-all market. Let's look at the actual math for 2026. Just 4 companies, Amazon, Microsoft, Alphabet, and Meta, have signaled a collective capital expenditure package of roughly $650 billion for this year alone. To understand how unprecedented this is, we have to look backward. During the peak of the 1990s dot-com and telecom bubble, the gold standard for modern tech mania, annual infrastructure spending hit roughly $200 billion, adjusted for inflation. But that $200 billion was spread across dozens of competing telecommunications companies. Today, Amazon alone has announced a planned capital expenditure of $200 billion for 2026. A single e-commerce and cloud company is spending more on infrastructure this year than the entire publicly traded U.S. Energy sector spends to drill wells, refine oil, and deliver gasoline. And the scale of this bet is fundamentally changing how these companies operate. For years, massive tech monopolies funded their pet projects through overflowing internal cash reserves. But the AI build-out is so catastrophically expensive that the cash reserves are no longer enough. Hyperscalers are now aggressively tapping global debt markets. The tech sector is issuing tens of billions in corporate bonds just to keep the construction of these server farms going, with estimates projecting they will need to finance over $1 trillion in new debt by 2028 just to keep pace. But the foundation of any healthy market is that massive investments eventually yield massive, tangible returns. You build a trillion-dollar factory because you have a $2 trillion product to sell. And this is exactly where the math stops making sense, and the bubble begins to stretch. The math keeping investors awake every night is the operational overhead. For every dollar a company spends on a high-end AI chip, they are forced to spend another dollar just on the electricity and cooling systems required to keep those chips from melting down. This is a constant drain on resources. To justify the $500 billion already dropped on infrastructure, leading analysts calculate that tech companies need to generate roughly $1 trillion in annual software sales just to break even. Where are we today? Generous estimates put actual generative AI software revenue at only $15 billion annually. That is a $985 billion gap, which is ridiculous because we are looking at a staggering structural deficit that shows no sign of closing. The core problem is adoption. Tech giants assumed that companies would immediately replace entire departments of staff with AI subscriptions. That is simply not happening in the real world. Businesses are finding that while AI is a decent brainstorming tool, it frequently hallucinates facts and fails when asked to perform complex, multi-step workflows that require precision. For most essential tasks, traditional software still works perfectly fine and costs significantly less to maintain. The final product simply does not justify the massive infrastructure cost at this stage. The demand gap is widening every single day as capital expenditure continues to rise while actual revenue trickles in. So why do these companies continue to double down if the math is so terrible? Because they are not building this infrastructure to run the chatbots we see today. They are building it for a much bigger, heavily marketed illusion. The narrative sold to Wall Street is that if tech companies just keep adding more chips and feeding the models more data, they will inevitably reach artificial general intelligence, or AGI. This is the ultimate carrot on a stick. It is the promise of an autonomous machine that can replace all human cognitive labor and generate infinite profit. But this utopian vision is crashing headfirst into two massive physical walls. The first roadblock is the data wall. AI models are not magic. They are statistical engines trained on human output. They have already consumed almost the entire public internet. Every book, every article, every forum post has been scraped. To keep growing at the promised exponential rate, these models are now being fed AI-generated data. Researchers are warning that training an AI on its own output leads to model collapse. The systems start to hallucinate more, become less reliable, and literally lose their minds. The pipe dream assumes infinite high-quality data, but we are running out of it right now. The second roadblock is the energy wall. A single AI query uses roughly 10 times the power of a standard Google search. The utopian promise of AGI requires a global power grid overhaul that physically cannot be built as fast as the data centers are being ordered. We are talking about hundreds of billions of dollars dropped on the promise of infinite intelligence, without enough electricity to plug it in. Our current power grids simply cannot support the exponential expansion these tech giants have promised Wall Street. So, they are essentially selling a science fiction future to justify a very expensive, deeply unprofitable present. To keep that future looking viable while the actual technology hits these physical walls, the industry has had to get very creative with its accounting. So how do these companies hide the terrible math and physical walls? They build an intricate echo chamber. Big tech companies are currently investing billions into promising AI startups. But these investments come with a strict, quiet catch. The startup must use that exact same invested money to buy cloud computing power and AI chips directly back from the tech giant that funded them. This creates a closed financial loop. The money never truly leaves the ecosystem. It artificially inflates the cloud revenue and hardware sales of the tech giants, making it look like the AI industry is booming, while masking the complete lack of profitable end consumer demand. But eventually, the market will demand real returns, forcing us to calculate the actual size of this wager. We must do the math on the speculative premium. Today, the top AI-related firms hold a combined market capitalization of roughly $25 trillion. If we subtract the realistically justified value of these companies, pricing them at normal, historical price-to-earnings averages instead of their current AI-hyped multiples, we expose the true scale of the speculation. That simple subtraction reveals an estimated $10 to $15 trillion in excess, purely speculative value. This brings us to the ultimate macroeconomic crossroads. If the skeptics are right, if artificial general intelligence is decades away and these models remain an unprofitable novelty, that $15 trillion premium could evaporate, threatening to drag the broader global economy down with it. But if the tech giants are right, and they actually manage to brute force their way through the data and energy walls to birth a true, autonomous digital workforce, then that $15 trillion is not a bubble at all. It is simply a small payment for a new reality. The bet has been placed. Now, we just have to see where the ball lands.